first flash that's coming in. FY26 GDP growth being seen in the range of 6.3 to 6.8%. So it's much lower than the expectation of 6.5 to 7%. So it is at the lower end, 6.3% to 6.8%. As Kanika was also pointing out that even the last time around, the survey had been more conservative as far as its growth estimates were concerned. So the economic survey projecting the FY26 GDP growth seen at 6.3 to 6.8%. Kanika, a first reaction from you.
So Shereen, as you said, credible, same as last time, 6.5 to 7. In fact, had they maintained it at 6.5 to 7, we would have said that they have actually lost their conservatism. But this time they are more candid. As CEA even wrote in that article, there is global uncertainty. In fact, it's only likely to increase this year. So we are in an environment with global and domestic challenges. So 7% plus numbers looks difficult to achieve. So in the current context, 6.3 to 6.8, we are at 6.5, looks more credible and a good number to work with. It actually is somewhere implying nominal GDP growth of close to 10% or lower.
Well, Kanika, I did a poll about 1 hour back and you also participated in that poll. And that was exactly 6.3 to 6.8. The highest number I got was 6.8. The lowest number I got was 6.3 for FY26. So, well, full brownie points for honestly reflecting the forecast of the economy. As Kanika pointed out, the more important number for the budget will be the nominal GDP. And over there, we have a range of estimates because so much depends on what you are assuming is going to be the wholesale price index. There is a little more clarity when you're forecasting CPI. WPI so much depends on whether China will dump or not, and therefore will commodity prices fall or not. So if you assume a benign commodity environment, then you have to assume a lower WPI and a lower nominal GDP. Last year, the budget assumed a nominal GDP of 10.5. And what did the MOSPI say? It actually was 9.7% FY25. So, there is a danger of assuming too much. But then given that base, will the WPI be higher? That will be the real number we will have to grapple with. But for the moment, I think you will have to give full marks to the economic survey for putting it exactly as the market is forecasting at this point in time. But Mr. Garg, if it is 6.3, very little maneuverability, isn't it, to spend? Okay, we cut to the finance minister.
The economic survey 2024-25. The economic survey 24-25 statistical appendix. Thank you.
सभा की कार्रवाई कल शनिवार 1 फरवरी 2025 को रात 11 बजे तक के लिए स्थगित की जाती है.
Okay, so that's it. The economic survey being tabled by the finance minister. The Lok Sabha stands adjourned now. We'll resume business tomorrow. We will, of course, get you more details from the economic survey. But that's the big headline that's coming in. Growth being assumed at 6.3 to 6.8%. That's the range that the economic survey is going with. And as we've been pointing out, this is really rooted in reality. It's a reflection of what we've been hearing through our poll as well. Let me bring in quick comments to that headline growth projection number from Mr. Garg as well as Mr. Chakraborty. Mr. Chakraborty, your first take.
Well, this was more or less expected because advance estimates peg the real number around this, so it's more or less in line. However, there is no reason to feel that 6.3 is a bad number. Let me put it this way, because considering the global growth scenario, to my mind, it's a very healthy number.
A healthy number. Mr. Garg?
See, I see this is quite realistic, 6.3 to 6.8, but slightly on the little optimistic side. So to me, it looks like that it might tend towards the lower side of it. And I can draw comfort from what happened last year. Last year also economic survey was very conservative, 6.5 to 7. But what we are going to see the growth for this year is on the lower side of it, or might be slightly lower than the 6.5%. So I would take it fair deal. Probably the chief economic advisor wouldn't have gone for below this. I would expect it 6.1 to 6.6 as the more reasonable, realistic rate. But I am happy with what has been stated.
Yes. Prashant, quick take on the markets and how the markets may have reacted to this?
I mean, nothing, Shereen. We're still trading up 220 odd points. And so far, I mean, I was also watching because, I mean, you know, as we've been discussing, if these are numbers and Mr. Garg is saying actually the number should be at the lower end, then, you know, will there be too much that the government can maneuver to provide help and stuff like that? I mean, you know, if anything at the margin, if expectations mean anything, the expectations go down a little bit about maneuverability in that sense. But so far, the markets have taken a little bit. I mean, it's small. I mean, 20, 30 points or so off from the highs on the Nifty. Otherwise, still about 200 points there, Shereen.
Yeah, because even if you have a 6.3...
Yeah, guys, I just wanted to come in. I do now have the economic survey with me. And as we've been pointing out, and again, this is something that the CA had spoken about as well. Deregulation is likely to be a big focus theme running through the survey. And that is what the Chief Economic Advisor is talking about. He says, going all out to attract, promote and facilitate further domestic and foreign investments, India needs to become competitive and an innovative economy. It will not be easy because competition for investment is not only with other emerging economies, but advanced economies too, who are determined to keep their businesses at home. Equally, investing in and strengthening domestic supply chain capability and resilience will be the hallmarks of strategic and long-term thinking on part of the private sector. Now, what is he suggesting in terms of measures to go all out is the question. Another priority related to the above that calls for a calibrated and careful approach is climate change and energy transition. Public policy will have to recognize the role of energy security and energy affordability in enhancing and maintaining competitiveness. It means that forging India's own path to energy transition and diversification away from fossil fuels. It will also require appropriate skilling and education for India's youth, and achieving competitiveness will be an incomplete project without raising productivity in the primary sector. Above all, underpinning specific policy efforts will have to be the philosophical approach to governance, getting out of the way and allowing businesses to focus on their core mission is a significant contribution that governments around the country can make to foster innovation and enhance competitiveness. The most effective policies governments, unions and states in the country can embrace is to give entrepreneurs and households back their time and mental bandwidth. This means rolling back regulation significantly. As I was pointing out, that's the core theme. Roll back regulation significantly. We'll have to go through the details of what that deregulation exercise that the economic survey is proposing. But the key headline, getting out of the way, that is the underpinning as far as the policy stance that the economic survey is taking. Mr. Garg, your first comment, sir.
So I think this is a very well said statement. You need to deregulate. We have too much of the laws, regulations, rules in the country. It has been pointed out many times, 60,000 odd compliances on the labor front alone by the industry. So I think that is fair. But the point is that in the context of budget, these don't amount to much. What does the budget do about it? I think this is what the government need to do for the entire year. If you try to shift from it, that what it might bring in the budget, I think if the budget deals with this theme, it might only be some sort of advices, some sort of exhortation, some sort of pious wishes, but not a real policy making.
Yeah, point taken, sir. I just wanted to point out, I ran through the contents to check out what are the themes. And as the CEA had mentioned in the edit in the op-ed piece in the Mint newspaper, I think there is a great deal of emphasis on the elephant and the dragon in the room. So clearly the India-China dynamics and polemics is going to be discussed. That's an important chapter. And he pointed out in previous occasions as well how we could use Chinese FDI. But this time he's actually going to point out that while we are getting freed from using fossil fuels and dependence on oil because of the rise of renewable, we are probably getting dependent on one country for a lot of critical elements in the renewable space. I mean, we know how much the world is dependent, and India is dependent on critical parts from China, including rare earths, rare minerals from China, especially for the renewable space, and even to some extent for semiconductors. So I think that's going to be a very big chapter on, how will be the new problems of trade dynamics given the importance of renewables. Let me just stress on the other point that Shereen very correctly pointed out. Getting out of the way of business. If deregulation is going to be the theme, Mr. Chakraborty, my question to you was going to be exactly that from the start. The 1991 budget, which we still hold as iconic, it did not give us a fiscal boost. It actually got out of the way. There is a better way to boost the economy by getting out of the way than by spending. Do you think there are any spaces where the government can do that? Just be less government. Have less regulations.
There is whole lot, frankly, all budgets, they do not give much space for more spending or less spending in that sense of term, because on the margins, the scope is very little. But on the policy making, the reforms, it's a very continuous process. And deregulation, frankly, is a music to my ears. I really like it, not only for, say, labor reforms, which central government has been working and perhaps should be working more on that, doing away lot more of laws which come in the way for an entrepreneur, but also for those areas which are regulated and need either lighter regulation or regulatory stance through not prescriptive framework, but more through a principle-based regulation. I guess that is a core. That's how I look at it. That wherever there are regulations, and perhaps needed also, they also need to be less prescriptive. That will open up lots of scope for a lot of entrepreneurial juices to flow. And that's critical. Whether it's an insurance sector or whether it's a banking sector or whether it's the electricity sector, there's a lot of prescriptive regulation which needs to slowly go away. It can't happen overnight. We have excellent regulators, but the regulatory stances have to be defined more in principal terms than in prescriptive terms.
Well, I'm just going through the summary of the many chapters of the economic survey. Chapter 6, of course, has to deal with the focus on infrastructure. The government has laid a special focus on infrastructure in the last 5 years. Reflecting this intent, the capital expenditure by the union government on major infrastructure sectors has increased at a trend rate of 38.8% from FY20 to FY24. It essentially gives you a breakup of the kinds of projects that the central government has taken forward as part of its infrastructure spending. The industrial sector is what it deals with in Chapter 7. But, it seems I'm still trying to get some sense of whether the survey has given a clear roadmap or prescribed where it believes that regulation needs to be pulled back or the government needs to get out of the way. But very quickly, as far as inflation is concerned, the expectation is that inflation will align lower. That's the expectation at this point in time. Good Rabi production is likely to contain food prices in the first half of FY26. There are many upsides to domestic investment and output growth and disinflation in FY26. Fundamentals of the domestic economy remain robust. Expect the FY26 growth in the range of 6.3 to 6.8%. Mr. Chakraborty, on the back of what the survey seems to be suggesting as far as both inflation and growth is concerned, the expectations now for rate cut from the MPC?
Well, whatever needs to be done for lower inflation, MPC should.
Mr. Garg, rate cut expectations, especially on the back of what the survey seems to be suggesting there as far as inflation and food inflation specifically?
I think the case for rate cut in India existed for last 6 months to 1 year. It's being delayed. I don't know for what good reasons. The consumer prices on which the RBI bases its rate decision is not in the control of the Reserve Bank, not as part of the monetary policy. So in my judgment, it should happen, whatever economic survey says or budget says, the rate cuts should be phased in now, at least 1% for next 6 months.
Again, another cautionary note here, and this is an extension of what the survey had kind of addressed last time around. And let me get Mr. Chakraborty to react to this. Risks pertaining to India's financial sector, that's one of the chapters that the survey talks about. There is evidence of increasing reliance on the financial markets as a funding source. Financial markets must work in tandem with the banking sector to bridge the capital requirement gap. Financial markets must grow in line with, but not faster than, the economy's capital needs and overall economic growth. Crucial to be aware of the potential vulnerabilities that must arise. India must prepare itself with appropriate regulatory and government policy measures to intervene and mitigate these risks when necessary. Banks need to enhance their capabilities to meet the demands of new age households and the digital economy while maintaining their primary credit creation function. Excessive financialization can hurt the economy. The cost may be particularly high for a low middle income country like India. This is what he had said last time around as well. Mr. Chakraborty, he's reiterating that this time. What's the message that you take away?
Government has reasonably kept its distance while promoting the growth of the financial sector. It has intervened for financial inclusion, development of and promotion of payment systems and so on and so forth, which has actually brought a lot of dividends and reduction of poverty, and also improving the velocity of money, easier payments, as you would have seen. Therefore, I guess banking, parabanking, fintech sectors, for them, as I mentioned, they need to be regulated, no doubt about it, but they would be regulated lightly so that they have their elbows free to do more and more.
But this excessive financialization risk, once again, I mean, we already saw measures coming in, especially on the F&O side and so on and so forth, because that was the overarching concern last time.
Well, that would happen. That is more tactical, in a sense that F&O, or for that matter, where people need to go or do not need to go. So that regulators can easily adjust by margin calls and those kind of things. So that's more tactical. Right. I don't see much of a strategic interference there. I think market should be allowed to play freely as much as possible. They'll improve their depth, and if anything where the government needs to come in, and I don't see survey acting on that, is development of bond market. Very critical, because banks can't provide long-term financing.
Right.
So perhaps they would have talked about it, and we have missed it. But I see development of bond market and necessary tax infrastructure for that as a key for development.
Latha?
I just want to make, Shereen, just one point. In the Outlook section, this is page number 32. And I'll just read out this portion, and this directly links to what we may actually, and we were discussing this in our program yesterday in the afternoon. It says capacity utilization in manufacturing remains above the long-term average, and private sector order books have shown steady growth. However, these gains could be tempered by global excess capacities in sectors like steel and others, leading to aggressive trade policies in search of demand. Now, and this is not just steel. We've been talking about the steel safeguard duty, which is with the industry has been clamoring for. But even for things like, solar wafers, etc. I mean, there are very few things this time around where there are specific expectations, unlike, 10 years back where there would be sector-wise lots of stuff which people would watch out for. But in terms of customs import duties, and because of these excess capacities around the world, could we see that being taken up? I think that is something which we'll just have to watch out for. I don't know if Mr. Garg has a view. It's also complicated because we have, the U.S. administration saying if you keep tariffs high, import duties high, we'll tariff your products when they come into the U.S. But any thoughts, Mr. Garg, on this?
I think this is a real catch-22 situation. There is a lot of excess capacity in several sectors in the world. You mentioned steel, whether you take EVs, whether you take solar wafers, cells, and many others. So I think there is that real risk is there. We have been trying to sort of put some restriction on this by putting the tariffs high, also to encourage the domestic manufacture. But in the absence of the core technologies, we have not been able to scale up the manufacturing in these areas very much. So how do you deal with it? Your higher tariffs are invites a lot of objection from Trump and America and others. And that strategy also doesn't work. So I think this will present a very difficult policy question for the government. How do you deal with it? In my judgment, I think we should go for lowering the tariff. Also take that other advice which has been there, that invite the Chinese, Vietnamese and others to manufacture in India. Open to do business with them so that manufacture here rather than trying to control through the tariffs. So I think the way to go forward is to reduce tariff and make India a better manufacturing hub.
Okay, I would just like to draw the panel's attention to what the survey is saying on increasing deregulation. And there are several examples there. And it seems the survey is, pinning some responsibility on the states as well, along with the center. In fact, I just want to quote a line in that particular chapter saying, ease of doing business 2.0 should be a state government-led initiative focused on fixing the root causes behind the unease of doing business. And also the survey goes on to sort of, give very specific examples where, this is impacting growth and sort of hurting sentiment. The example here would be current regulations act as binding constraints on growth by increasing the cost of market entry, force-fitting inefficient models for operations and prolonging industrial sickness. For example, factory regulations make it cheaper for a business to run 250 worker factories rather than one 300 worker factory, discouraging economies of scale. So these are the kind of bottlenecks that the survey says that the center and the state governments need to focus on. But the onus is not only on the center. The survey says that states need to focus on ease of doing business.
The government has brought this point up repeatedly. When you define something as MSME and the benefits are given, then nobody wants to become larger than that number, that threshold. That is repeatedly pointed out. In fact, I would request all of you to get to page 156, which is the deregulation chapter, and there is a table on approach to reform, description and the current status. So the survey points out what has already been pursued in phase 1 of ease of doing business and what may be pursued in phase 2 of ease of doing business. And that's where what Surabhi says, liberalize standards and controls, set legal safeguards for enforcement, reduce tariffs and fees, like minimize or remove the mandated charges for certain utility, for inflating the utility costs. That's exactly what they're inviting the municipalities and the state governments to remove unnecessary charges and fees.
There's an interesting facet here, Latha, and these are all in the 2.0. So the survey has now brought forward the concept of ease of doing business 2.0 and the things that need to be addressed there. And that's what, some of the points that Latha was reading out. It's saying use risk-based regulation, tailor legal norms to the risk profile of businesses and involve third parties in enforcement. These are some of the suggestions that the survey seems to be making.
Instead of giving a one-size-fit-all, you tailor it to the extent of risk that a business faces. Reducing tariffs and fees. For instance, one of the grouses of the central government is the high and erratic stamp duties on land in various states, but the states will tell you, you sit in our position and you know that that is the only way to make money. The rest of it is taken away as GST.
I don't know if all of this, right? I mean, gives us a sense that this is going to be if the eco survey, and you ask that question, how relevant is the eco survey in the context of the budget? But if it is relevant, does it look like a guidance type of budget tomorrow? With a laying out what needs to be done rather than a lot of stuff actually in it? Because it's possible. We've had a few of those budgets
Shereen
as
will
well.
get a chance to interview the chief economic advisor, and we will have to pose that to him. But I want to again say that the budget did point out that there will be an economic policy framework extending for the next 4 years, and it is quite possible a timetable of deregulation, a timetable of reduction of tariffs, and cooperation between centre and states on various issues, even stamp duty for that matter. Shereen, my sense is that there could be a roadmap since that economic policy framework was promised.
Yes, so we will have to wait to see how much they detail by way of that roadmap. But, Latha, again, as I point out, that all of this boils down to execution. Is this the first time that we've heard somebody within the policy framework and the government talk about the need for deregulation? Is it the first time that we've heard an economic survey also say that, look, we need to unshackle MSMEs? I mean, go back to even his predecessor, K.V. Subramaniam, and, even before him. I mean, these have been themes that have been talked about in many economic surveys, but the question boils down to execution. And I want to come back to, I think, what will really be the focus and should be the focus as far as the budget is concerned tomorrow, and that comes back to private capex. And here's, again, as I was pointing out, this has been something that the CA has been talking about for a while now, and he's kind of alluding to that once again. Public investment has sustained capital formation in the last several years, even as the private sector has shed its balance sheet blues and begun investing in FY22. Now it has to receive the baton from the public sector and sustain the investment momentum in the economy. The signs are encouraging. Even last year, if you remember the conversations that we had with the then Finance Secretary, Mr. Somanathan, it was very clear. He said, look, there is a limit to how much we can do as far as capex is concerned. The private sector needs to start and needs to do more. And that's the message that the government is sending out, or at least the economic survey is sending out again. Mr. Chakraborty, would that be one of the big signals that you pick up from the survey again, that the baton now needs to move to the private sector?
I guess the government's role in building up infrastructure will not completely go away. Let's face it. However, private sector could come in where they are viable. Those assets are to be monetized either through InvITs or through REITs. There are so many other mechanisms, or plain simple privatization. That's one area where private sector can come in, or areas like airports and all, where they are there in big way. However, government's role is likely to be there. What one has not seen over last post-pandemic period is little capex coming from private sector. Or I would rather use the word not commensurate investment coming through as one thought would come in. Perhaps that was driven by the domestic demand, considering that there were uncertainties globally. They still exist today, and there are a lot of, as one may use the word, predictable unpredictabilities, DeepSeek being the latest one. Therefore, obviously, they would be driven by what kind of demand they are, and our other than few IT or pharmaceutical, most of the other sectors are more constrained by their lookout only on the domestic demand. They also need to hunt demand globally, so that they can create those capacities and bring economies of scale, or be part of GFCs, which is global supply chains. However, one part we see that in GCCs. Global capability centers, which have grown very large, and they are actually a part of a supply chain in a sense. And that's very critical, and that's where the duties play their part, because if the duty is very high, then really the supply, we get out of the supply chains. But it is a chicken and egg situation, and one has to play that very, very deftly as one goes along, so that the dumping doesn't take place and we don't lower our guard. There are geostrategic imperatives which also need to be kept in mind in all these things. Therefore, there is nothing like passing the baton. Both the things operate.
We'll have to work.
And there is a limit to what government can possibly do. But as the GDP grows by investment, both private capital formation as well as the government capital formation, perhaps higher GDP will permit higher investment and a virtuous cycle build.
Yes, that is right. But Mr. Garg, on that question, should we temper expectations in terms of these record numbers that we have been seeing as far as government capex is concerned?
Yes, I do see that very clearly. Number one, the resources available with the government are much smaller than would it be. And but I think government will not let go the USP of the capital expenditure so as yet. And therefore, there would be a plus kind of addition to last year's the capex target. As I said, I see it about 12 trillion rupees or so. So it is not going to go away. But the broader question which we have been discussing about passing the baton or raising the animal spirit in the private sector, I think this question is not handled by only making a lot of exhortations or advice. This have been given for many years, as you have also rightly noted. The government can only influence it by tweaking the policies, whether on tax side or the regulatory side or on the other side. And that is the instrument which should be used rather than the exhortation. So I think that's, otherwise the private sector is not in the business of doing charity. They won't make investment for the sake of investment. Government may make it, but not the private sector. So don't expect the private sector to take the bait of the offered through the advice and exhortation rather than the real policy change which makes the difference for them.
Yeah, and I just wanted to point out some of the sectors that the economic survey is focusing on. Sectors to transform include travel. Again, this has been a low-hanging fruit that we've been speaking about for years now. Health, recreation services. Remember, we've been talking about this experience economy opening up and what that could potentially mean in terms of having a multiplier impact as far as job creation is concerned. So the survey highlighting that the sectors to transform include travel, health and recreation services, untapped sectors, telecom, insurance and pension. Those are the three that they point out as untapped sectors. The survey also making a note of caution as far as the FDI trade outlook is concerned. India needs a new strategic trade roadmap. Global trade dynamics have shifted significantly from globalization to protectionism. India must reduce trade costs and improve facilitation to boost exports. Industry must continue to invest in quality, also highlighting that it's going to be a challenging environment as far as FDI is concerned. Latha, Prashant, anything more that you wanted to add?
Yeah, well, there is a fairly detailed paragraph on the softening of gross fixed capital formation. You know, one of the reasons why the second quarter numbers saw a dip, the GDP number, was because capex fell from 10.1% in the first half of FY24 to 6.4% in the first half of FY25. I'm taking both quarters, Q1 and Q2 together. And the survey goes on to argue that this could be temporary. Private sector investment may have remained subdued on account of domestic political timetable. I mean, they were waiting for elections to get over, global uncertainties and overcapacities. But they have reason, I mean, the big paragraph where they point out that we have reason to believe, paragraph 1.40, the slowdown in investment activity is likely to be temporary. Green shoots are visible. The union government capex is up 8.2% if you took July-November. You know, we all know that if you took April-November, then it is minus 12.5 compared to a year ago. Yeah. But he is pointing out that if you took July-November, it is up 8.2%. That is the capex spend. Early results of the RBI's order books, that is that Obicus survey they do, order books, inventory and capacity utilization. That shows that manufacturing firms' capacity utilization has reached 74.7. The long-term average is 73.8. So when it goes above the long-term average, people normally invest in fresh capacity. That's the argument they're making. A private sector report's analysis of a sample of capital goods companies indicates order books of these companies have risen by very sharply by 23.6% in FY24 as against a CAGR of 4.5% in the preceding 4 years. So in 4 years, it is 4.5. Of course, those are, two of them are COVID years. But 23.6 indicates that capex is on the rise. And then finally, the Reserve Bank's report on private investment showed that investment intentions increased to 2.45 lakh crore for FY25, a study of about 2,500 companies. The year before, it was 1.6 lakh crore. So that, again, is a doubling of capex. Mr. Chakraborty, are you convinced? After all, you head a bank, which I think concentrates still on retail. Have you seen any signs of capex?
No, my bank also does a lot of wholesale work. In fact, it's one of the largest wholesale banks after SBI. That notwithstanding, I am not a great fan of intentions. I would rather see the investment on the ground. If that is so, then wages would also rise because there would be competition for getting more skilled labor in, and that will provide larger employment. Therefore, I like to really smell the coffee when the things are really there. At this stage, yes, perhaps some intentions would come in, but early days.
Early days, and the survey also says that the signs are encouraging of private capex. But here, Latha and gentlemen and Kanika, you know, I think this again, as I've been pointing out, this has been reiterated now by the economic advisor in his public engagements, through his writing and his speeches publicly, and it's now in the survey. Here is the message, the clear, sharp message to corporate India. And I quote, "It is in the enlightened self-interest of the Indian corporate sector swimming in excess profits to take its responsibility to create jobs seriously." I'm repeating that. This is the economic survey. It is the enlightened self-interest of the Indian corporate sector swimming in excess profits to take its responsibility to create jobs seriously. What do you take away from this statement, Mr. Garg? What could it result in terms of policy action, if anything at all?
See, two things. I don't think the government or the chief economic advisor is a better judge of what is in the enlightened self-interest of the private sector. So let it be left to the private sector. How does it think what is best in their enlightened self-interest? Second, I think this statement that they're skimming in very large profits, I think that phase is also over. This year's corporate earnings, if you look at, the profit increase, etc., is down. It has started coming down from the last year. The extraordinary profits which were there in 21-22 and 22-23 are now looking like a distant past. So I don't think we can base, or the government can base, an advice for investment based on a very high degree of corporate profitability.
But does this also signal, and I'll get Mr. Chakraborty and Kanika to comment on this, does this also signal that we must temper expectations then on any further big bang incentives or any incentives to aid private capex, to aid corporates at this point in time? Would that be the broad read, the broad understanding? Kanika, let me start by asking you.
Sure, thanks, Shereen. So actually, I will go with what Mr. Garg talked about. A moral suasion doesn't work with the private sector, even if the CA has been asserting the same time and again. But then 3 points in my view. First, maybe what we can look for in this budget is anything for labor-intensive sectors. So maybe another PLI scheme or an investment incentive, because the private sector, yes, the large corporate houses have really gained, but the labor-intensive sectors are yet to show up that capacity utilization of 74-75% that the CA may be talking about. So maybe something to push the private sector towards, specifically towards labor intensity of manufacturing sector, that becomes very important at this juncture. Second point, as you rightly pointed out, last time round as well, they had given a number that listed companies are giving, are showing in FY24, 8.5 lakh crores of total capex, 20% YOY, but it's all very K-shaped recovery. It's all led by mainly sectors like, power, auto, iron and steel, maybe cement somewhere, some refineries here and there. But broad basing of private capex recovery is what I would personally want to understand from the economic survey and the budget tomorrow. Last but not the least, as everybody has been pointing out, at the core of the issue is weak demand, which is impeding that broad-based private capex recovery. So what is it that the government wants to do to reinvigorate that demand engine in the economy to facilitate the private sector to start investing and start oiling the economy via tax cuts, maybe more transfers, maybe labor-intensive sectors, jobs. But this is the core area I would want to understand from the budget tomorrow. Thanks.
Yes, we will all want to understand what the budget has to say on demand creation and, of course, on some of those key numbers and how much of the intention and the sentiment that the economic survey is putting forward by way of prescription translates into policy action. But we will say thank you to our budget editor, Atanu Chakraborty. He'll, of course, be with us bright and early tomorrow morning right here on CNBC TV 18 as we decode the budget numbers live, as we always do. Many thanks to Subhash Garg as well as to Kanika for joining us here on CNBC TV 18 to take stock of the economic survey and the messages that it sends out. We'll see you again as the budget numbers are revealed. But we will take a quick break. Don't go anywhere. We're back in a moment with more. Stay tuned to CNBC TV 18. We're decoding the economic survey. We're talking about the budget and, of course, the markets. Back in a moment.